This week, you're going to begin to examine a special market, and one that's a little bit different than the four market structures we've examined in the last several chapters. The market that we're going to examine this week is the labor market. And the reality is, hopefully the labor market is something that you will, at some point in your life, if you've not already encountered, you will begin to encounter this. And hopefully out of this chapter, you'll gain a little bit more insight into how the labor market actually works. And then we're going to discuss a few cases that are special and unique in the labor market, that of a monopsony and that of the union. But the labor market really is one of those things that most students, at least, desire to participate in. One of the things that you'll begin to examine in this chapter relates to the wages that people end up earning relating to the things that they're doing. So let's first examine what makes the labor market so unique and what makes it different from the other markets. In the other markets that we've discussed, the perfect competition, monopoly, monopolistic competition, and oligopoly, it was the businesses that were the suppliers and we, the consumers, were the demanders. But in the labor market, consider who really supplies labor. It's us, it's the individuals. We're the ones that own the labor and we supply the labor, and the businesses have the demand for this thing called labor. So the labor supply functions pretty much like any law of supply would indicate. It's an upward sloping supply curve. And the law of supply simply says as the price rises, the quantity supplied will also rise. So according to the labor market, the price is our wage. So the price of labor is your wage rate. So as the wages rise, the quantity of labor will also increase. And I usually illustrate this by asking the class to simply raise their hand if they're interested in becoming a kindergarten teacher. I may have one or two, but I usually don't have a lot. And then I will tell students, well, you might have an opportunity to impact a child's life. And maybe you'd have an average salary of about $20,000. And I don't usually get a whole lot of takers if the average salary were $20,000. Then I say, well, what if our country decided to pay kindergarten teachers really what they're worth? And we were to say that kindergarten teachers are very valuable and let's pay them $100,000 per year. How many of you would be interested in being a kindergarten teacher at $100,000 per year? I usually get a few more hands. Then I'll raise it to $250,000 per year. And I get more hands going up. Now, one year I did have to raise the wage to about $1 million a year before I had my last student who would say that they would do it. And really the reason was they just weren't really crazy about kids. So the labor supply is an upward sloping supply curve just like before. That makes sense. It's not really so unique. What's different is the demand for labor. So the demand for labor is derived from the demand for the product or the service. If there's no demand for the good or the service, then the business doesn't have any demand for the labor to produce the good or service. As the demand for the good or service increases, the demand for labor to produce that good or service will also increase. Now, one of the concepts that you'll discover in this chapter is the idea of marginal revenue product. So there's that word marginal, which just simply means incremental. So in chapter 7, we discussed marginal product, which is the additional product that an additional worker can produce. Marginal revenue product is simply the marginal product times the price of the good. So one of the things that we discovered in chapter 7, we looked at marginal productivity. As we hire more and more workers, do you remember what happens to the marginal productivity? So remember, you've got something that's fixed in the short run. So marginal productivity ends up decreasing the more workers you hire. If you'll remember in chapter 7 lecture, we talked about an example. I think it was making sweaters or shirts, but we only had one sewing machine. So adding more workers didn't really give us more and more sweaters that were being produced. So we have this idea of diminishing marginal productivity. Well, if every additional worker is giving us less and less product, if we were to have to hire more workers, I really wouldn't want to pay them as much because I'm not getting as much revenue from those additional workers. So wages would have to go down. Well, what that means is you end up with a downward sloping demand curve. Sort of makes sense. At really low wages, the firms might demand a higher quantity of workers, but at really high wages, they really won't demand that many workers. And it relates to this idea of marginal revenue product. So let's imagine it's tax time. H&R Block is hiring accountants to complete tax forms. And let's say that if we hired one accountant, they could produce 6 tax forms. If we had 2 of them working together, we could make 19 tax forms. If we had 3 of them working together, we could get 29 tax forms. So marginal physical product is just simply the additional product that is produced by hiring one more worker. So as I go from 0 workers to 1 worker, my product goes from 0 to 6. That's a marginal product of 6. As I hire my second worker, the second worker gives me 13 more tax returns because I went from 6 to 19. Finish the rest of that column. And you'll notice that marginal physical product does diminish. The more accountants that are hired, the less each additional accountant will be producing. Well, if the price of a tax return, if they're getting $100 in revenue for every tax return, if they had one accountant, they'd have 6 tax returns at $100 a piece. That's $600 of revenue. If they had 2 accountants, they'd get 19 tax returns at $100 a piece. That's $1,900 of revenue. Marginal revenue product, you'll notice, is just the incremental change in revenue. As I go from one level to the next, I go from $600 to $1,900. It's a difference of $1,300. As I go from 19 to 2,900, that's a difference of 1,000. But you'll also notice, here's where the marginal revenue product formula makes sense. Marginal revenue product is marginal product times the price of the product. So my second accountant adds 13 additional tax returns at $100 a piece, means the second accountant gave us an additional $1,300 of revenue. The third accountant gave us 10 additional tax returns at $100 a piece, means the third accountant gave us $1,000 of additional revenue. Well, if the wage is $100, it would make sense to hire the third worker because they gave me $1,000 of additional revenue at a cost of $100. That makes sense. So try to remember the rules for maximizing profit in the last several chapters and see if you can apply it to this market and figure out how many workers will be hired if the wage rate was $100. So remember, marginal revenue equals marginal cost. Same thing sort of applies here. They'll end up hiring 5 workers because the marginal revenue product of $100 is equal to the wage rate of $100. You can easily see why it makes no sense to hire the 6th worker. The 6th worker gave us no additional tax returns, but cost $100 to get that 6th worker. That doesn't make any sense to hire the 6th worker. So essentially, you're going to hire up to the point where marginal revenue product equals the wage rate. Well, it's the same thing as marginal revenue equals marginal cost. So So here's another market, same sort of concept. Pause the video, complete this chart, and then we'll examine where to hire at different wages. So my first picker will give me an additional 5 boxes of strawberries picked. The second worker gives me an additional 5 because I went from 5 to 10. The third worker is going to give me an additional 4 because I went from 10 to 14. This is nothing new. You should be able to do this. That's from chapter 7. Marginal revenue product is just simply marginal product times the price. So you'll notice that marginal revenue product goes down as the number of workers goes up. That's a demand curve. So if the wage rate was $6, how many workers would be hired? 4 workers would be hired because that's where marginal revenue product equals the wage. What if the wage rate were to fall to $2? How many workers would be hired? They'd hire 6 workers. So again, you see it's a demand curve. You have a downward sloping demand curve, just like before. It's just a little different concept by throwing in the idea of marginal revenue product. But again, the demand for the workers depends on how much additional product each additional worker is going to give us. So we will end up with an equilibrium wage in which demand and supply intersect. And just like before, the equilibrium wage is going to be where those two intersect. So in this case, it looks like it would be $4 and 4 workers. Now, one of the things that we often ask ourselves is, why do people get paid different amounts? Why is it that teachers are paid so little and football players are paid so much? It has nothing to do with the value or worth of a person as much as it has to do with the market for that particular labor. So in the teacher labor market, there's actually a rather large supply of people willing to be teachers. And as the supply of teachers increases, the equilibrium wage is going to fall. So interestingly, you have many people who desire to be teachers. Maybe they desire to have the same days off as their kids. Maybe they desire to have summers off. Even though you do sort of work as a teacher, you do kind of work over the summer, but it's just maybe not in the classroom. But there's lots of people that do desire to be teachers, and many students are in school to become teachers. Now, I would ask this question: what if the demand for teachers were to increase? For example, what if our country said every teacher in K through 12 will have class sizes of no more than 4 students? We would have a huge increase in the demand for teachers. Well, if you shift the demand curve to the right, you'll notice the equilibrium wage would end up rising. Maybe if there were such a rule like that, we'd end up paying kindergarten teachers $100,000, simply because the market would indicate that. So why is it that football players end up earning as much as they do? Maybe it has something to do with the fact that there's actually a small supply of people who are capable of throwing a touchdown pass in the pressure of a Super Bowl in front of thousands of screaming fans. I mean, I can throw a football in the backyard, but put me in front of other people and I probably won't make it. So maybe there's a decrease in the supply of people who can be football players at the professional level. And maybe football becomes really popular and the demand would increase even. But even if there were just a small supply of football players, you notice you would have a higher equilibrium wage. So the reason that many people are paid different amounts has to do with the market for their particular product or their particular type of labor. So this is one point in the semester that I always like to remind students. As you enter the labor market, you need to make sure to really hone your employment skills. Please make sure that your resumes are up to date, that they're perfect, that there are no grammatical or spelling errors, that it looks good. I always tell students, don't try to make your resume look artsy and cutesy. Just make it very clean, straightforward, put all the facts in there. Don't get long-winded. I've seen resumes for individuals who really have no experience, but the resume went on for 3 pages. That resume won't be read. The resume that's full of typos, that'll just get tossed in the trash can. Please make sure that your resumes are up to date. Please make sure that you know how to communicate with people and how to do an interview. And in a virtual setting also, know how to have a virtual interview, because more and more are happening these days. And they were happening even before the COVID-19 pandemic. I was on a committee just recently, several years ago, in which we were doing phone interviews. And unfortunately, there was a candidate who actually was doing a job interview for a pretty high-level position. They were doing that job interview while they were driving. They were distracted, and they actually lost service. We had to try to call them back again. It really was not a very good interview for that person. And you think about the skills that are needed in the job market. Try to really be successful at learning new things. I always tell students, maintain your integrity. It only takes a slip, and it's hard to recover that. So please maintain your integrity. I always advise students to please maintain clean social media. Don't have reviews of a business on your Facebook account in which you talk about how terrible and lousy your experience was, and then go try to get a job there. They're going to look at your Facebook page. So just try to be professional and keep your skills up. And that's how you have a better chance of being successful in the job market. Now, there's 2 special cases in the labor market. And the first we'll talk about is a monopsony. Notice the S. So remember, a monopoly is when there was one supplier of a good or service. A monopsony is where there's one demander, and in this case, the demander would be for labor. And oftentimes, a situation arises in which you have a labor force that really has no choice. They kind of have to work for this one company. They can't really move around very much. Maybe the skills aren't there for any other kinds of occupations that they might be able to move to. So, for example, in eastern Kentucky, in coal country, in the Appalachians, we had the existence of what were known as company towns. And the company town essentially was owned by the coal mine. The coal mine owned the mine, obviously, but they also owned the schools, the banks, the grocery store. They owned everything. And essentially, if you lived in that area, you pretty much sold your soul to the company that was in that area. So there's an old song called 16 Tons. If you're interested, listen to Ernie Ford's, the lyrics of this song. And it talks about what it's like to live in an area in which you only have one demander for the labor, and you really don't have many choices. So in this type of market, the supply curve looks like we've talked about before. So I have a supply curve here in which, as the wage rises, the number of workers would also rise. But we're going to look at this from a little bit different perspective. We're going to look at it from the costs if I had to hire that many workers. So if I had to pay one worker, if I just needed one worker, I could pay him $10 and I'd have my one worker and my cost of labor would be $10. But if I needed two workers, the only way I could get more hands raised is to raise the wage to $20. Well, that means my cost of labor would be $40. If I needed three workers, I'd have to raise the wage to $30, so my cost of labor would be $90. Okay, so then in this last column, it's MFC. That stands for marginal factor cost, which essentially is the additional cost that you're going to incur by hiring an additional worker. So as we hire more workers, how much does our cost rise? So I go from 0 workers to 1 worker, my cost rises by $10. I go from 1 worker to 2 workers and my cost rises by $30. Finish the marginal factor cost. And now what we're going to do is graph the supply curve, and then which is the first 2 columns, and then we're going to graph the marginal factor cost. So when I graph the supply curve, it's an upward sloping supply curve, just like before. But when I graph my marginal factor cost, it's a curve that's actually above our supply curve. Now we're going to add onto this a demand curve. So we're going to say that our demand curve, I'm going to give you a function. So those of you who have had algebra, you can graph a function. But if you've not had algebra, essentially what this means is that your wage rate, your marginal revenue product, is equal to this function, 65 minus 5L. So if labor is 1, we plug in 1 for L. So 65 minus 5 times 1, that's 60. So my wage rate for 1 worker would be $60. If I had 2 workers, so I'd have 65 minus 5 times 2 is 10. 65 minus 10 is 55. So if I needed 2 workers, a wage rate of 55 would be the quantity demanded and supplied. So from here we get a demand curve. And now what we're going to do is try to determine where we're going to maximize our profits. So think back to the market structures we've looked at. And remember that your demand curve is your marginal revenue product. So you're going to maximize profits where marginal factor cost equals marginal revenue product. So in this case, we're going to maximize our profit at 3 workers, but we only need to pay them $30 because remember, we're the only company in town. If all we need is 3 workers, $30 will get 3 workers to raise their hands. So essentially what we do is we find our equilibrium quantity and go down to the supply curve in order to get the corresponding wage. Now I challenge you to think about this market structure and see if you notice any similarity with the other market structures we've talked about. So if you think about it, this is kind of like the monopoly, but it's almost like a mirror image. Remember, in a monopoly, we did marginal revenue equals marginal cost and went up to the demand curve to get the price. With a monopsony, we're going to go down to the supply curve to get the price. And the last type of special case we have in the labor market is the idea of a union. Unions have been around for quite some time. In the medieval ages, we had craft unions. These were things like goldsmiths and blacksmiths and silversmiths, all people that did the same craft. And even today, we have craft unions. So for example, there's a union for bricklayers. There's a union for pipe fitters. There's a union for electricians. Those are craft unions. But in the 1900s, we also had the development of what were called industrial unions. So these unions essentially organized workers who all worked in the same industry. They may be doing different jobs, but they all work in the same industry. So for example, there's a paper workers union. Paper workers union consists of the mechanics at the paper mill, the janitors at the paper mill, the secretaries at the paper mill. What's common is they're all working in the paper industry. And typically when we think of unions, really what they're trying to do is trying to manipulate the labor market so that maybe the members of the union can get better working conditions or benefits or higher wages. That's oftentimes one of the things that they will try to do. And in order to do this, the way that they can do that is possibly to increase the demand for labor. So there are places in which employers are required to hire union workers. So the unions will negotiate a contract and they will negotiate for higher wages. If they don't like that contract, they'll go on strike. And all of a sudden the employer has no workers. So the power of the union lies within the strike. The union also might try to decrease or diminish the supply of labor. So for example, many types of unions have apprenticeship programs. And these are cases where they'll tell the employers, you know, if you want a quality carpenter to help build your house, you want to hire a union carpenter because they've been through an apprenticeship program, as opposed to just somebody walking off the street who says, yeah, I can pick up a hammer. So really what the union tries to do is to influence the labor market, and they have the power of the strike to try to negotiate these contracts. Problem is unions really are losing their power these days. It used to be a very large portion of our labor force was unionized, and that power is diminished, mostly because the workers don't really feel as though the unions have that much of a significant impact upon the wages and the conditions. Now, imagine what happens if you have an industry in which there's a monopsony and a union. So for example, in coal country, the coal companies are the monopsonist, and the United Coal Workers Union is a very powerful union. They're the union. And oftentimes they're at odds with each other. And so maybe the unions go on strike for better wages, but maybe the employer, the coal mine, just says we don't like that, and they'll close the doors to the workers. They'll have a lockout, which essentially says you don't get into the mine to do your job. So there's no money there. So in our country, we've established a National Labor Relations Board, and we tend to try to mediate any of these kinds of disputes because these tend to get rather contentious. So out of this chapter, you should have picked up on just the basic supply and demand of labor, where the equilibrium wage is, and how different occupations will get different wages based on the supply and demand of labor for those types of things. And then we examined the monopsony and the power of the union. So this chapter discusses this special market, the market for labor. The next chapter is going to present one of the failures of this market system.